The time is now 2 o'clock, and we will call this meeting August 20th, 2025, the Oklahoma City Deferred Compensation Board. Item number 2 on our agenda is to approve the minutes from the May 21st, 2025 meeting.
You can just voice vote for now. How do you wish to
approve?
Okay.
Anyone? Second.
And the motion passes. We've got a presentation next. Trampus Bright from Voya is here to talk about the quarterly plan review.
Sounds good. Thank you, everyone, for letting me be here today. I'm substituting for Adria. She is on vacation, so she nominated me to come and give the plan review for the board. Again, as always, thank you for your partnership. I think it's been a great, 6 months now, a little bit over 6 months. So again, really appreciate your partnership and look forward to continuing the good things here at Oklahoma City. If we start on page 4, first we look at the digital engagement. And that's those individuals, your participants, that's actually interacting with Voya at a digital level using our mobile app, website, etc. Right now, if you look on slide 4, we have a little over 4,889 participants with account balances in the 457 plan. Average savings rate about 8.1%, well ahead of the national average, so that's good. And the average savings balance right around $98,000 in the 457 plan. And then on the right-hand side, just we break down the participants by gender and also by different age bands, and it's exactly what you would think would be kind of a bell curve with the plan. If we look on the next slide, this kind of looks more into gender, but if we look on the right-hand bottom graph there, average savings rate, all the different populations, age populations are pretty even, so that's really good to see. 7.8% for the 20 to 29-year-olds, and then also 50 to 59, right around 8.5, 60 to 69, 7.4. So all across the board, all the different age groups are saving a good percentage into the 457 plan. If you look on the next slide, now we'll talk about the 401A when it comes to the plan. 182 participant account balances in the 401A plan. Average savings balance would be right around $294,000. Again, you can see the different graphs there. When it comes to 401A plan, we don't track deferrals or calculate income replacement, so that's not factored into this. But you can see the different unique participants with the different age groups there. On the next slide, this is looking at engagement through all different plans, and again, different mediums, website, mobile app, the call center. We have about 20% of the participants that have reached out to the call center over the last quarter. The mobile app, about 25% have interacted with the mobile app, and then the website, right around 52%. When it comes to those statements, e-delivery, right around 29%, so about 1,500 employees are getting e-delivery with their statements. And you can see their web registration is about 56%, so 2,700 participants, which I think is fantastic. A lot of times we'll see about 10, 12, 15% interact with the website and get signed on, so I think that's a testament to our education and the technology that we offer here at Voya. So really happy to see that. And then you can see at the bottom, and I thought this was interesting, the different age groups. Again, we're breaking it down by age groups, and all of them are interacting with the website, so that's good to see. No matter how young or how old, everyone's participating and getting registered through the website. And then also people are utilizing the mobile app. On our next slide, again, this is looking at it over the last quarter. So the last 3 months, you can see web logins are down slightly, which you would assume would be the case, right? After you go through a transition, people are excited at the very beginning, making sure all of their assets got transferred over, and then as you go throughout the year and it gets longer and they get more accustomed with Voya, then you're going to see some of those logins decrease. So logins have decreased, users have decreased going on and looking at their website, so that's down a little bit. We have about 625 over the last month that have logged in, unique users, to their web account. Mobile logins, looking at the mobile app, that's actually increased, so that's good to see. People just probably checking their account balance on their mobile phones. And then users are down slightly, so you got some repeat offenders there going out there and looking at their account balance. Call center, again, you can see calls are going down, which is, again, what you would expect after you come out of a transition, so no concerns there. If we go to slide 10, and I'll slightly touch on this because I know HCG will talk about this in more depth, but you can see there the last 3 quarters for both the 457, 401A open and the 401A closed. The market's been up and down, so you can see the overall account balance is up or down, but as of 6/30, assets were right around $481 million in the 457 plan, $16 million in the 401A open plan, and about $37 million on the 401A closed plan. And again, I know, like I said, HCG will cover the investments, so we'll skip on down to slide 14. Here we're looking at cash flows coming in and out of the plan. We had rollover contributions in the second quarter, right around $261,000 coming into the plan. If you look at the top left-hand corner there, looking at the 457 plan only. Cash outs, so we had withdrawals of right around $1.4 million, installment payments right around $1 million, terminations close to $11 million, so those are money outflows from the 457 plan. So the net cash flow out of the 457 plan is right around $6.8 million. And we'll talk about where some of those distributions are going momentarily. For the 401A open plan, again, we have a net cash flow of $231,000 coming into plan. Terminations were right around $7,500 in that plan, so not a lot going there. And then when we look at the 401A closed plan, we did have a sizable terminations, right around $2 million going out, and that's there in the middle there. So the net cash flow out of that plan is right around $2.1 million. On the next slide, kind of breaks it down a little bit further. So if you look at the 457 plan only, you can see what type of terminations are going out, are happening within the plan. You can see that the biggest one there would be the full distributions, right around $8.6 million. The second would be a partial distribution of $2.8 million. And then bottom left-hand graph there are the actual distribution counts. So the 8.6 million in full distributions, that's right around 79 participants that took money out of the plan in the second quarter. Installment payments, right around 388 individuals are taking installment payments within the plan. If we go on to the next slide, 401A plans, again, full distributions, $7,500, rollover source distribution, $2,000. We had 3 full terminations within the 401A plans, so not a lot to report on there. Next slide, slide 17. This is looking at the 401A closed plan. Full distributions right around $2 million, and that's made up of one distribution. So one individual took their money out of the 401A closed plan in the second quarter. And then if we go to the next slide, slide 18, this is where you can see, this is speaking to the 457 plan only, where those distributions are going. So Raymond James, Charles Schwab, Ameriprise, UBS, Edward Jones. So just a lot of the familiar financial advisor names that we know. Unfortunately, it's part of the business. When somebody terminates, they get a lot of phone calls, a lot of free lunches. So we'll continue to educate on the fees and the great investments we have in this plan, and hopefully get an opportunity to counsel some of those participants into the good benefits of the OKC plan. Any questions there? Okay. The next couple slides, this kind of talks about fund-to-fund transfers for people moving their money around. Nothing major there that I saw. ACG, again, we'll cover more of that. So I want to jump on down to slide. If we go to slide 26, we'll talk about the call center. Again, those slides are mostly just talking about investments. So here on slide 26, this is the call center. Again, we have it broken down by month. ASA, if you look at the very top hand chart, ASA, average speed to answer. So you can see most of those phone calls are being answered this last month within 6 seconds. There's been no abandonment rate, so we're actually speaking to those individuals. The service level there is right around 100%, meaning that we have certain guarantees that our performance guarantees we try to adhere to. There you can see 100% in the last quarter. And then you can also see calls entered, calls accepted. Average handle time right around 8 minutes is how long those calls are lasting. Average hold time, 36 seconds in case they need to transfer to a different department. And then average talk time right around 6 minutes at 29 seconds. So FCR is something that we really look at, first call resolution. So we want to make sure that if a participant has a question, we answer it right then and there, and there's no repeat calls or repeat emails. You can see there we were 100% in June of 2025 and an average of 93.3% for the last quarter.
Can you help me understand the service level? Like what does that mean? Or I'm trying to figure out what that percentage is.
So our call center,
Yeah.
internally, they have certain metrics they work off of.
Okay.
Overall, they're trying to get a 95% service level when it comes to average speed to answer. And I think that average speed to answer is right around 7 seconds.
I guess so. That's like the average speed to answer gives you the average, but there might be some outliers, and this kind of
Correct.
gets at in June, 100% got answered within the time frame that's expected.
Correct, within 7 seconds.
Yeah, okay, got you. Thanks.
Yep. And then you can see at the very end of that survey, so we always ask a participant to provide their feedback through a survey, and then we report that back to you on an annual basis. And then the next is our chat options. So you can see there individuals that have interacted with us through chat and the different reasons why they're interacting with us. So again, that's another option for a participant as well. If we go to slide 28, so now talking about the on-site education. So Rebecca and her team coming out and providing education to the city. I think through, as of right now, we're currently sitting at 55 days of education that we provided within the city. And you can see there in April, 102 participants reached out, the different meetings and locations that they've provided there. May, about 153 participants reached, and in June, 198 participants reached. Any questions with education? Overall, I think we've heard very positive feedback on education, and people have been able to get their questions answered. If we go to slide 30, so we can continue to, send out our communications. Kevin Rudman, who is a communication consultant, we've mailed out several pieces in March of this year. We had the beneficiary mailing in May going out to making sure everyone has a beneficiary on file. I think we have a little over 1,200 individuals left within the plan that do not have a beneficiary, so that'll continue to be a focus of the team. And then the planned outreach for the third quarter would be account registration and cybersecurity. So we'll continue to try to get those account registrations up. It's when you think about cybersecurity, one of the major ways someone can take over your account is if you've never registered your account. So it's always important to go out there and do that as an individual, and that's what we want to continue to educate on.
Registered.
56% of your population have registered. So if you go to slide, I'm missing a page number. If you go to the next slide. There, well, this is speaking to beneficiary outreach, but yeah, this is the beneficiary outreach. Right around 1,258 people are missing a beneficiary. And then as of July 2nd, right around 1,206 people are missing beneficiaries. So it's something we'll continue to educate on. But back to the account registrations, yeah, it's right around 56%.
And on that, we had a mailing of the account registration on August 13th, and it mailed out to about 2,100 people who still need to reach out.
Yep. On the next slide, just an annual calendar of how we're communicating to your participants. We have targeted initiatives, so that's something directly focused on the city and the goals and needs of the city. So we talked about the beneficiary outreach. Coming up third quarter would be the account registration, so we're really going to be focused on that. We also have personalized financial wellness. So think of email messaging, text messaging. And this is really for the participant. Think of the next best step. So if you're not in the plan, you should get in the plan. If you are in the plan, you should think about increasing contributions. If you've stopped saving, restart savings. There's a birthday message in there. So these are all just automatically targeted to a specific participant and pushed out. It says turn on. It is in the process of being turned on. I think Kevin is working on that. I spoke to him earlier. He said that should be in process. Then we have quarterly education content. That's going to be more of a general education from Voya going out to your participants. And then, of course, we have always on our Voya Learn. So if you want education through online seminars, you can get that 365 days, 24/7. And that's what I have prepared for you today. Any questions?
Any additional questions for Trampus? Well, thank you.
Thank you. Again, thank you for your partnership.
And there is no action related to that presentation, so we appreciate Trampus once again for coming out. We'll move on to item 4, which is to receive the investment consultant report. And Jason Pujols from ACG is here.
Thank you. Good afternoon, everybody. So just a few comments on the markets. As I came in, I heard Ralph talking about his balances. So we have a good chart on the lower right here that probably addresses that. But this year, we've seen pretty broad-based equity rally in U.S. Large cap, non-U.S. emerging markets. The one area that hasn't really kept up is small cap U.S. Across the board. But in terms of your funds and the offerings, what you have, they're all performing in line with expectations. But what this chart on the lower right shows, if you guys were looking at your balances early in the year, you saw large cap stocks and small cap stocks in the U.S. Go down about 20%. With the announcement of tariffs, we saw a lot of volatility in the equity markets. That chart is showing the S&P 500 down about 19% from February 19th through the end of March. But we've since climbed back up in U.S. stocks, particularly large cap, and sitting at all-time highs again. That said, non-U.S., which has been an area that hasn't done as well over the last decade, and you see that reflected in participant balances. There's a lot more when we look at participant balances in a defined contribution plan or a participant-directed plan. You tend to see a lot of the participant-directed assets in what's done the best looking backward. So the Fidelity Contra Fund, which is a large cap growth fund, technology heavy, that has huge balances. I did notice in Trampus's material, when you see transactions, there was a pretty big outflow from that Fidelity Contra Fund. Hopefully that's participants that are rebalancing into other areas to benefit their portfolio. But this year, On the upper left, that shows year-to-date and then just June returns. The year-to-date numbers are probably more relevant, but the two best performing asset classes have been emerging markets and international developed, which is the MSCI EM, or Emerging Market Index, up 15.3% through June, and then the MSCI EFI, which is international markets, up 19.4% through the end of June. And so for those participants that are maintaining diversification in a somewhat balanced portfolio, those areas that haven't been as helpful over the last few years really benefited you in the first quarter of this year. A lot of that is due to the dollar. As we've seen the dollar with the onset of a lot of this tariff and trade policy, the dollar has weakened relative to foreign currencies, and so that's been a positive. Just moving on to some of the plan data. If we could flip to the next one more. Okay. Here's the plan balances as we show them. I'm not really sure why the numbers are different than what Trampas showed. We'll look into that because we get the data from you all. I'm guessing this might have something to do with some of the holdback from Mission Squared and Nationwide, that there might still be some dollars there that's still in these plans that's not showing up in the VOI numbers, because it's a few million, but we'll look into that, why there's that difference. But nonetheless, from a participant and relative dollars, 457 plan, the largest by far, the open plan at 16.4 million and the closed plan at 44 million. As you all know, if we go on to the next one, Mary Ellen, all three plans now have a consistent menu of options. So as trustees for participant-directed plans, your responsibility is to make sure that participants have a diversified set of options to choose from for those participants that want to develop their own asset allocation or their own investment portfolio. We've done that by having actively managed options across every asset class, both growth and value, as well as index or more low-cost options in the core space. So participant presumably could have their large cap allocation split between growth and value in the Fidelity Contra Fund and the Vanguard Windsor Fund, could do the same in small cap and international, or they could choose to still develop their own asset allocation with low-cost index funds using the core options. More importantly, the qualified default option is the target retirement funds, which you see down there in the lower right. These are all Vanguard target retirement funds. The underlying investments are using all index or passive strategies, very low cost, that are diversified across all of the other asset classes that you see on the page. And those target retirement funds adjust over time based on the participant's age. Younger participants, they're going to be in more aggressive strategies that have more equity. As you get closer to retirement, those vehicles adjust the risk or the equity allocation over time. Ideally, we'd like to see more and more dollars moving into those, and I think with education you'll see that. So quality, diversified set of low-cost options across the board. Go to the next slide. Here you see within each plan where the dollars are. This is solely a function of where participants are moving their money. A lot of this at this point still is from mapping over from the options in Mission Squared and Nationwide, where we mapped what each participant was into the most similar strategy on the new platform. You're starting to see, based on some of the numbers that Trampas showed, some of the dollar movements in and out of funds, some rebalancing. We're going to try to upgrade this view for you all in the coming months to roll the target retirement funds up into just one option. It's not, we're showing each series by itself. Really what we're looking for is how much in total is in target retirement funds. That would give you an indication of participants that are using the qualified default option. Not surprising to see, this is not unusual that we see with participant-directed plans, a significant amount of the assets in an asset class or strategy that in the rearview mirror has done very well. So U.S. large cap over the last decade is up 15%. The next best asset class, U.S. small cap, up about 8%. Within U.S. large cap, growth equity or technology has done the best. The Fidelity Contra Fund represents that. So you see a lot of participant dollars are floating into what's done the best over the last 10 years. Not necessarily what you'd like to see going forward. You'd like to see a little bit more balance, but it's not unusual to see that. The other, the one thing to point out on this slide, loan balance is zero, or not. Not the loan balance. That's not what I wanted to point out. The self-directed brokerage. So this is the option that you put in place that participants that want to choose some of their own investments. So out of $500 million in this plan, there's $2.35 million in the self-directed brokerage. So meaning participants that are choosing to utilize that are, but it's a pretty small percentage of dollars. I don't know how many participants that is, but it's a small percentage of dollars. The next slide just looks at the open plan, similar in terms of ratio of dollars as to what we're seeing. I think this one, self-directed brokerage, there's none. And then the final one is the closed plan. Similar story, self-directed brokerage, none there. But allocation and ratios, the largest allocation is to the Fidelity Contra Fund, and then the fixed account, the Mission MSQ Plus, that's still that fixed account that is not moved over yet. So that will move over. That's their stable value. In terms of just monitoring of the funds, we put together a couple of pages that are hopefully the next 2 pages, next page here. This is a very quick snapshot. Green and red, and this, we've got the metrics that we've identified in the investment policy that we're evaluating. So performance, 3 and 5 year performance relative to the benchmark, 3 and 5 year peer group ranking, are quant metrics among other metrics that are being evaluated. So these are the easiest black and white things to show, but other things that we're looking at through our ongoing oversight of these investment managers through meetings with them is just the stability of the firm, the stability of the investment team on the strategy, understanding when there is some relative performance differences above or below the benchmark, what's causing that. And then we're also showing, because we expense ratios and a Morningstar rating. Morningstar rating is not part of your criteria. We're just showing that in the event there's interest here. So I'll point out there's a couple of managers where on the relative performance that you see some red, and I'll go into a little bit more detail. So the Loomis small to mid cap growth, 3-year return 9.43, and the benchmark's up 12.38, and 5-year return 7.34 relative to the benchmark 7.42. So really on the 5-year in line with the benchmark. Peer group ranking a little bit below median on 3-year, and 5-year right about the median. If we go back in the book to page 32, just to drill down a little bit more. So just by way of background, this Loomis small to mid growth strategy, this tends to be, it's a small to mid cap growth strategy that is focused on what they would describe as higher quality companies with consistent earnings, consistent cash flow, In the small cap growth market, and particularly this quarter that we're ending on, you see the quarter ending June, which is the 3 months, the small cap growth benchmark was up almost 12%. The strategy is up 8.48%. Within the Russell 2000, the Russell 2000 and then the growth benchmark, about 60% of the companies in that benchmark are what are considered non-earners. They don't have positive earnings. So it's a pretty low quality benchmark. Active managers, particularly that focus on quality are going to limit themselves primarily to those companies that have positive earnings. What happens with the benchmark when the benchmark really runs up, and in the month, it's really the last month, it was June, which impacted the quarter, and then it's happened again this month. It was expectations over rates declining that fueled the whole small cap market. Small cap as a whole was up. And so all the names in the benchmark go up. Typically, active managers aren't going to own those. This is a manager that we wouldn't expect to necessarily own those lower quality names, but it's impacting the endpoint that we're measuring. If we look out over 10 years, you can see the strategy is up 10.6% annualized, and that includes that most recent quarter where the benchmark's up 9.3, so they've added 130 basis points relative to the benchmark, and they're above median relative to peers. The other measure, if we look at standard deviation, which is a measure of risk, this tends to be a much lower volatility, and you see that across the board, and this is reflective of that higher quality nature of the strategy. So I'm going into detail on this because these are the types of things that we look at and want to understand the manager. On that very black and white page where it's just yes or no, we may see times where over a short period of time it's being impacted by the endpoint and the manager strategy. I'm sorry, Marilyn, if we could go back to that page 12. On the bottom are the target retirement funds. The target retirement funds, while we do compare them to a benchmark, these benchmarks for target retirement funds are different than a investable index that we would use for a large cap growth fund or a small cap growth fund. These are a benchmark of other target retirement funds. So it's more a grouping of funds for a similar age range. The dispersion you see there, it really is reflecting slight differences in asset allocation for what the Vanguard target retirement funds may be using versus Fidelity or BlackRock or other target retirement funds that might have slight differences in, or in some cases might include asset classes that aren't even included. So what we're looking for is to be comparable to these benchmarks. Sometimes we'll be a little bit over, sometimes you're going to be a little bit less, and I'd say we're all in the neighborhood here. The more important thing here is we're trying to offer these strategies for participants that really want just that glide path that's going to adjust over time in terms of equity market risk at a very low cost. And as you'll see here, the expense ratio on these funds is 8 basis points across the board relative to the median across the target retirement fund universe, about 30 to 40 basis points. So these are very low cost options. So again, as trustees for a participant directed plan, we want to make sure we're offering a diversified set of options that are reasonable and low cost, that participants can develop their own asset allocation, and a target or qualified default options, which in this case is the target retirement fund suite, that are of quality nature and fairly low cost. We'll continue, we are ongoing monitoring your managers. It's not just on performance, it's on a number of other metrics: risk, volatility, team, firm stability, looking at asset flows in and out of these managers. When and if there are issues with certain strategies, we will come to you and suggest changes, or when and if there are potential things or holes in the offering, certainly talk about that. I know one of the things that's certainly getting a lot of press recently is a lot of talk about legislation that would allow private market vehicles to be utilized in retail or participant-directed plans. That's something we're doing some work on. It's not available yet. I would assume there'll be demand from participants. And it's kind of a slippery slope as we look at some of these options, what they look like. We think they're going to be expensive. They're going to be watered down versions of traditional private equity that institutional investors can go into. But it will be something that we evaluate and we'll want to talk about with the board.
I was going to ask something about that at the end of your presentation, but one of the things I read that said that the most likely spot we'll see that come in is some of these target date retirement funds. Are you seeing or hearing anything along the lines of that?
Yeah, I would anticipate that you're going to see some of these providers put them in their target date retirement funds. Because they're going to get, it's going to increase fees for them, and there's going to be demand. There is benefit to private markets' ability to enhance returns, but the difference between a pension fund that's investing directly into a private equity fund that has a 10 to 15 year lockup and no liquidity, where you're investing in illiquid investments, and what these vehicles are going to look like that are going to need some liquidity, that's going to impact the return expectation, because the strategies, whether they're in a target retirement fund or an option in the lineup, they're going to have either cash or public securities in them to create some liquidity that's going to bring down expected returns. That's not to say that participants aren't going to demand that that's an option. I brought it up because I know it's going to be a topic that is going to need to be addressed.
Absolutely.
As that legislation moves forward. And
On a kind of backing up a little bit to like your Loomis sales review, let's just say down the road we do decide that we need to offer another alternative to that fund or in that area. Would the normal expectation be that we would just offer an additional choice, or would we move people out of, I'm just picking on Loomis sales because you mentioned it, and they would move out of that into whatever the new choice is without having an option?
correct.
Okay.
It'd be the latter. You don't want to, that's what happened before, and then, where it just balloons into a bunch of options. But as fiduciaries, you all are fiduciaries to oversee the options available. If you determine that you need a different option, we would change that out.
And everyone would switch?
And you would
Okay.
map. Yeah.
Thank you.
That's all I had.
Any other questions for Jason?
Thank you.
Thank you. And we do need a motion on receiving this investment report. Got a motion and a second. Mr. Votes? And the item passes. Next is items for individual consideration. This item is to approve the amended attachments and addendum incorporating the collective investment funds and then their related instruments into the money purchase plan, the open plan, the closed plan, and the deferred compensation plan. This is a continuation of, remember we ratified this in March, and to move this with the CIT, the Collective Investment Trust, and this is just the continuing forward with that. So are there any questions on this item? Okay. That would entertain a motion. And cast your votes. And the item passes. Do we have any comments from the board? We do have comments from staff.
I just wanted to mention the retirement office and our legal counsel's been working through a request for a merger of funds for the Central Oklahoma Transportation and Parking Authority. They joined the Oklahoma City Plans January of this year. However, they have remaining assets with the previous vendors, and so they've frozen those accounts, and we're working through the administrative pieces of that. And so there's going to be a likely possibility that we're going to need to have a special meeting in October sometime, just due to timing, and let the board review whether we're going to accept those assets and different things like that. So I just wanted to make sure everybody's aware of that.
And that would be dependent on the COTPA board making an action on that. So that would be a prerequisite to us having any sort of special meeting. We should also have our new trustees, possibly by our next meeting as well. And so we could not have a vacancy on the board. Any other comments or questions? With that, we can adjourn this meeting at 2:41.